worked last time, last class. Maybe we'll get lucky and still be there. Nope. What did I do different? Nothing. Maybe I didn't let it open all the way or something. There it goes. I'm hitting something wrong when I'm doing it. I guess it is. All right. So, what do we need to do here? These are investments in other companies, right? So a company invests in stocks and bonds of other companies. You guys already know how to handle investments in bonds where I'm going to hold them to maturity, right? We just did that. So we did bonds payable and investment bonds at the same time. So you know how to handle that. So if I'm going to hold the bond to maturity, right? Yeah, you just amortize the discounted premium, okay, over time. What if I'm going to hold it less than that? How much control do you have over a company if you invest in their bonds? You get to run the company? No, not at all. So you're a passive investment. The authors talked about a passive investment. So you're a passive investment now. So you are going to be either an investment in trading securities or available for sale short-term or available for sale long-term, okay? It's going to be just like you had an investment in stock where you will own what? When I say an investment in a marketable security, investment in trading securities, available for sale short-term or available for sale long-term, how much do I own in that category? Let's read that up. About a third. Okay. How much do I own if I'm going to have an investment in a trading security or an investment in an available for sale short term? Or I'm going to have an investment in an available for sale long term. How much do I own? These are called marketable securities. I'm holding them to sell. Marketable. Got it? These are marketable securities as a group. How much do I own? And how much control do I have? These are passive investments the authors talked about, right? Passive investments. I don't have any control. I'm taking what the market gives me. So these are going to be no control. And what percent is that is the key thing. How much do I own? So the first thing I'm worrying about when I invest in other companies, stock, right, is how much control I have. And if I invest in their bonds, I already have no control, right? When would, if we vote, if the shareholders vote, when would my vote not matter? How about if I own one share out of a million? What happens when we vote? They win, I lose. Got it? Anybody who has very many shares at all, I'm insignificant, own one out of a million. What's the number? What did the author suggest? Where you have no control. Up to how many shares? 20%. That's the key number. If you got that, you got it made. You have no control if you own 20% or less. Got it? Now, what if I own 20% of, if I own 20% of Ford Motor Company? I don't have any control. It's the family members, right, descendants, still control the company. When they vote, they win. Right? Typically, it's a Ford that is the president of Ford Motor Company, or one of the descendants, right? Not necessarily Ford, but still family member. Why? Because the family still controls it. Okay. What if you own 20% of General Motors? You're the biggest shareholder, right? Now we'd say we have significant influence, not no control. Got the idea? So it's a judgment call. So this is just a rule of thumb. 20% is a rule of thumb, okay? What I'll do is I'll say you own 1,000 shares out of a million, or you own 100 shares out of a million. What do you think? You have no control. You're a passive investor. Okay. So if I'll make sure it's way less than 20%. Got the idea? If it's 10, 15, still no control. Got it? Okay. So that's no control. And it's going to be called one of those three things: investment in trading security, available to sell short-term, or available to sell long-term. Okay. Well then, what's the other end of the spectrum? No control versus control? What do you think? Probably. Okay, when would I have control? When we vote, I win. What if I own 51% and you own 49% of the stock and we vote? Who wins? I do. I'm in control. In fact, you would be no control, wouldn't you, at that point, probably? Maybe not. You have 49. You probably have significant influence. Okay, I'd probably let you have some say. Right? Okay, but I'd certainly be in control. So I basically own the company if I own more than 50%. Okay, so this is going to be 50% up to 100%. Got it? Yeah, I'd have control. And what we're going to call this is investment in subsidiary. And you can put the company's name on it: investment subsidiary, ABC company, or whatever it is. Okay? I own them, right? So anywhere between 50 and 100%, I'll call it an investment in subsidiary. Okay? And the reason is I have control. Everybody got it? So no control, control. Guess what? In between is what? Over 20% up to 50%. Got it? In that range in between. What do I have then? We call it what? What do the author call it? Pick up on that? Kind of a good term. Some control, right? Less than total, more than none. We call it significant influence, okay? So here's the deal. First thing you do is you determine how much control you have. And how do you determine that? I have investments in other companies. How do you determine how much control I have? What do I own? What percentage? What if it's less than 20%? No control. What if it's 20 to 50? Significant influence. What if it's over 50? Control. Okay, now if I have significant influence, I call this, it's not a subsidiary because I don't own them. By the way, subsidiary means I'm the parent, they're the subsidiary. They have a subsidiary relationship to me. Got the idea? So it's a good name for it. I mean, investment subsidiary, right? What do we call it if we have significant influence? Instead of investment in subsidiary, I would call it an investment in an affiliate, okay? Affiliated company. And you can put their name on there too. Investment affiliate, XYZ company, whoever it is. Got it? So this is pretty simple when you break it down that way, don't you think? Not too bad, right? So the first thing you're going to do is decide how much you've got, okay? Now what we're going to do if we have no control is we are going to use the market method of accounting for this. Okay? Market method. If I have significant influence, I have investment in an affiliate, I'm going to use what's called the equity method. Okay? And if I have control, investment in a subsidiary, I am going to use consolidation. Okay? The author didn't show consolidation in the chapter. I'll add that next time we'll do it, okay? And I'll keep it real simple, just the initial consolidation. When you look at a lot of companies, I worked on the Memorex audit when I was in make tape and stuff, right? Memorex. They electronic gear. Memorex owned something like 300 subsidiaries. They owned 300 other companies. When they do the financial statements, they combine themselves with 300 other companies. You got the idea? Because they own 50% or more of 300 other companies. Way back then. Okay? So you got the idea with this thing over 30 years ago. Right? So companies own lots and lots of other companies. Right? So they just consolidate them because they have control over all of them. Put together all their assets, all their liabilities, eliminate all their equity. You're going to call it an elimination entry. So I want to show you that, because when you look at financial statements for any companies of any size whatsoever, it's going to be the company name and subsidiaries. Consolidated financial statements, they're going to call them. You see it over and over and over. So I want you guys to know what that is. Go out there and start working. Okay, good. All right, so those are the three basic categories. Got it? So what's the first thing you're going to do? As soon as I give you an investment in another company, what are you going to do? Ask yourself what? How much control do you have? If I own less than 20% of the stock, or it's a bond, right? I have no control, right? Or it's preferred stock, because I don't get to vote with preferred stock typically, right? Where am I going to be? Right there, no control. Everybody agree? So it's going to be one of those three. And we'll go through these three today, okay? All right? What if I own between 20 and 50%? Significant influence, right, guys? And I'm going to be where? Investment in affiliate. That's what I'm going to call it. Okay? That's it. What if I own between 50 and 100%? I have control, and what am I going to call it? Investment in a subsidiary. Okay? This could be pretty simple, huh? Okay, so let's get this a shot. By the way, I am doing this completely differently than I did with the first class, except you're now. Same stuff, though, but completely different. Do you want to watch the other one when you're getting ready for this quiz? Might be a bad idea, right? Two different approaches, the same thing, okay? Have you guys found looking at old semesters, I do it differently different times? Yeah, doesn't make any difference, right? I used to really worry about that stuff. When I was first teaching, I wanted to be the same, and bull, right? It's what you get, not how I deliver it, really, okay? All right, so let's see what you pick up. Let's record some. Let's make up a little example. Let's say I'm buying stock in XYZ company, and they have 1 million shares, okay? And the stock is selling for $8 per share. That's its market value, right? At the time we buy it. Everybody got it? So all these are going to be buying XYZ. Okay? In this first category, we have investment in trading securities available for sale short term or available for sale long term, right? In the second category, we'd have investment in affiliate, and the third, we'd have investment in a subsidiary, huh? So how many shares of stock, what would I have to be less than for it to be less than 20% of 1 million? Something less than what, 200,000? So let's say I buy 2,000 shares. If I told you bought 2,000 shares out of 1 million, would you know that they have no control? And this is simple, right? Okay. What percent is that? 0.2% or something? 2,000 out of 1 million. 0.2%. 0.002, right? Okay. Everybody got it? And this is nothing, right? No influence at all. Okay. No control. All right. Where would I have to be if I'm going to have significant influence? How many shares would I have to be between? You got 1 million, right? It's got to be 20 to 50, right? So what? 200 to 500. So let's say it's 250,000 shares. Got the idea? Okay. I got a 25% interest. Everybody agree with that? Clearly, I've got significant influence. I got an investment in affiliate. Okay, and then what would it have to be for it to be a subsidiary? More than 50, so let's say it's 800,000 shares. Got the idea? Which is 80%. Okay. By the way, the portion of the company I don't own is called minority interest. Don't mess with that next time. Okay? Somebody else owns 20% if I own 80%. Okay? Other people, not if you one person. Okay, everybody good? All right. So the first thing is what percent I own, and that's going to determine my control. The next thing you have to decide is if I am less than 20%, am I an investment in a trading security, investment in available for sale short term, or investment in available for sale long term? So what are those things? Okay, here's the deal. In all those cases, I am a passive investor, right? I am holding the stock for what? Hopefully gain in market value and dividends paid to me, right? Go to do it. Okay, I didn't invest so I could run the company. Under the significant influence where I'm going to use the equity method, or with control where I'm going to consolidate, I'm running those companies. With control, I totally run it. When I vote, I win. With significant influence, I have a lot to say about running it. Does that make sense? So there, I'm not just taking what the market gives me, I'm making the net income happen by running the company. That's the theory. Huge difference between a passive investment in trading security or available for sale, short-term or long-term, and investment in affiliates or consolidation. Huge difference. And the thing is how much control I have. Got it? Okay? So that's going to drive the accounting on this. So that's what you got to get down. Okay, so then what happens if I have no control over here, and I certainly have no control if I own 2,000 shares out of 1,000,000. How do I decide if it's an investment in trading security, available for sale short-term, or available for sale long-term? Okay, here's the deal. Short-term and long-term are easy. What defines something as a current asset, short-term? I'm going to hold it for what? Less than a year, right? That's it. A year or less. What am I going to hold it for more than a year? It's long-term. That's it. Okay, so those two are simple. If I buy it, I'm going to hold it for 6 months. I'm going to debit investment and available for sale short-term. If I buy it and I'm going to hold it for more than a year, I'm going to debit investment and available for sale long-term. Okay? So the only one that is going to be hard is determining if it's an investment in trading securities. So what is that? This was a political compromise. Okay? It's how we handle the income, the gain or loss on a change in market value. It's different between a trading security and an investment and available for sale. Okay? What the deal is when we decided as a profession, as a business community, we decided that we should really show stock at its fair market value. If you own Young brand stock, do you know what it's worth today? Sure, you can look it up online and see what it's trading for. You know exactly what it's worth today. It's being traded, right? Any publicly traded company, right? Major corporation, right? Of any size on an exchange, right? If they're selling that stock, we know what it's worth every day. So should we put on the balance sheet what it's worth today, or what it was worth when you bought it 10 years ago, maybe? Probably what it's worth today, don't you think? Okay. So that was easy. Everybody decided, hey, we should show all these stocks at market value. It's called mark-to-market. You'll hear about that throughout your career, right? Fair value account, market value account, right? We're going to record it at market value. Why don't we do that with land? I don't know what the land's worth unless I sell it. Got it? I'd have to use appraisals, and boy, those are rough, right? Okay. So on these assets, we think they should be at fair market value, so we record them at market value. By the way, when it increases in value, everybody loves it. What about if it goes down? Not so happy, right? But we show market values, okay? Doing the increase or decrease in the asset was easy, but what do you do with the other side? If it increases in value, what do you have? A gain, right? Everybody thought that was a great idea to put those gains in the income statement. But what if it goes down in value? You have to credit the asset, right? Trading security or available for sale short-term or available for sale long-term. You have to credit the asset, don't you? If it goes down in value. What would you have to debit? Asset goes a loss. You got it, okay? Right? And nobody wanted to put those losses in the income statement. Also, they didn't want to show their income bouncing up and down, because if your income is changing a whole bunch, so the stock market goes up and down, right? That would cause your income to go up and down even more than it would just from your regular earnings. Does that make sense? That makes you look more risky, by the way. So that would discourage people maybe from investing in other companies, because their income's going up and down then, right? Which affects their market value. We'll do that when we do Accounting 211. Those of you who do that class, finance accounting majors. But when you do finance 315, everybody's going to do this. Okay, you're going to take a look at it. Okay, so it's called the beta of the company, the variation of your stock returns relative to the whole market's variation is what it is, and it's supposed to be a measure of how risky you are. Proxy for the risky ones. Okay, anyway, so because we couldn't decide what to do with this stuff, right? These gains and losses. It was decided that anything that was available for sale long-term, where it started at, told you it's political compromise, where it started at was available for sale long-term, the gain or loss was going to go straight to an other comprehensive income account. Remember we briefly mentioned that, I think back in chapter 5 maybe? You know, they talked about this other category of gains and losses that people did not want to put on the income statement, and they go straight into equity. Do you think it's going to be important to read the equity statement for companies? Oh yeah, where are you going to find their unfunded pension costs? In equity, not on the income statement. Where are you going to cost related to that? Where are you going to find their gains and losses in the stock market holdings? That's where that's going to be. Ah, so it could be a really big number. In some companies, they have negative other comprehensive income that's bigger than their retained earnings. What does that mean? Yes, they don't really have any retained earnings. Okay? But nobody wanted to run it through the income statement. And by the way, I kind of agree with that because these might be temporary, right? When the stock market was up around 13,000, my wife thought we were rich over 7 years ago now, 8 years ago, I guess, before George Bush, the end of his presidency. The market went down from 13,000 to 6,500. Boom, like a month or so, right? Bottom fell out. My wife says we lost half of our wealth, and I said, no, we didn't. I didn't sell a single share of stock. I want to sell when it's low, I want to sell when it's high. How about you guys, right? So of course you don't sell. Why did the bottom fall out, by the way? Because everybody's selling. They're crazy, like lemmings to the sea, guys, right? You know, you're jumping off a cliff, so I think I'll do it too. Kind of. Everybody wants to buy when things are high and sell when things are low. What's wrong with them? It should be the other way around, right? Okay? You only do that if you're going to get a tax break by selling when it's low. I've had to advise clients on that sometimes. We'll talk about it some other time, right? If it's not going to increase in value and you're in a loss position, sell it, right? Take your loss, put it in the tax return, save taxes. Otherwise, if it's going to go up, well, people don't sell. By the way, you know if the stock's going to go up or down? Of course not. That's what risk is. Okay? But anyway, she was really upset about it. And I said, hey, don't worry about it. It'll recover. What's the market right now? Close to 18,000. So it's 3 times what it was when it was down around 6,500 almost, right? Everybody got the idea? Don't sell when the bottom falls out, huh? So the point is, maybe those aren't permanent, right? Maybe those gains and losses really aren't permanent, so maybe they shouldn't go on the income statement and affect the gain earnings. That make sense? Okay, so the idea was the short-term ones were going to go on the income statement, and the long-term ones were going to go into other comprehensive income. But then people said, no, we think it'll adjust before that. It's too long. A year is too long. It should be something less. So we started talking about how much less. And finally said, well, if it's going to be for a very short term, you can call it a trading security, and then that'll go on the income statement. And anything that is longer than that, available for sale short term, in other words. So trading security is now, what most people do, a day up to a few weeks. If it's more than a few weeks up to a year, it's an available for sale short term. So we have this very, very short term category. Got the idea? And that's the only one that directly hits the income statement. Okay? Now what are we going to call these gains and losses on trading securities and available for sale short term and long term? We're going to call them unrealized losses. Or if it's a gain, unrealized gains. Now, what do we mean by unrealized versus realized? Remember this? I told you guys this. What does recognize mean? In accounting, I recognize something when I make a journal entry, put it in the financial statement, right? Recognize an asset, liability, equity, revenue, expenses, just debit here, credit here, right? Gain or loss. Okay? Right, guys? When you make a journal entry, you're recognizing it in the statements. What does realize mean? When you realize you're paid. You get the money. That's different when you earn it than when you earn it. You guys agree with that? You guys know about accrual basis, accrual and deferral. Can you earn your salary and get paid next year? Can you earn it now and get paid, later? Yeah, typically that's what happens, huh? Okay? So accrual would be I'm earning it, right, as time goes by, right? That'd be recognition. Realization is what? I get the cash. Everybody agree? That's for revenues, it's for expenses too. Okay, anyway. So we're going to call these unrealized gains or losses because we haven't sold the stock yet. By the way, when you do sell the stock, it's like any other asset. You'll have a gain or loss. Everybody agree with that? Okay, so anyway, there's quite a bit in this chapter, but if you can make sense out of it, it's not too bad to have. Not really. Okay, so that's what the deal is going to be. So what did I say an investment in trading security is? I am going to hold it for Less than a few weeks. Okay? Investment available for sale short term? Longer than that, but up to a year. Investment available for sale long term? More than a year. Got the idea? That's it. All right? So the first decision is what, you guys? I'm looking at that clock over there. The first decision is what? How much control I have. As soon as you know how much control you have, you know which one of these three categories you're in, right? It's either a marketable security, the first column there, okay? It's an investment in affiliate, right? Second column. Or it's an investment in subsidiary, the third column. Depending on how much you own, right? Then after you determine how, and that's how much control you have. So when do you have no control? When you own less than 20%. When do you have significant influence? When you own between 20 and 50. When do you have control? When you own more than 50. Is that kind of common sense? I know the 20% is just a rule of thumb. But is it kind of common sense these would work that way? Okay. All right. So now let's try the investment. So here I'm buying 2,000 shares. Okay? Here I'm buying 250. Here I'm buying 800. Guess what the credit is going to be in every single case. What account is it going to go to? Let's make the investment. Let's do the investment. I'm investing all the way across. Let's do the investment for those. What are you going to credit? What account are you going to credit when you invest in stock? Cash. No kidding. Okay? So we're going to credit cash. You're going to get these right, aren't you? Credit cash, credit cash, credit cash. But how much? It's $8 a share and I bought 2,000 shares. How much do you think you're going to credit cash for? 16 grand. Everybody agree? What if it's 250,000 shares? It's $8 a share. How much is that? What's the whole company worth? Yeah, it's $2 million. What's the whole company worth? A million shares at $8? What's that? $8 million. In the first case, I own 16,000 out of 8 million. You got the idea? Certainly no control. Okay. In the second case, I have significant influence because I own $2 million out of 8 million. I own a quarter of it, right? What's it going to be if I own 80%? 800,000 times 6,400,000. Out of the 8 million, I own 80% of it, right? Everybody agree? Okay. What am I going to call it if I only own the 2,000 shares? 0.2%. No control. Three things I could call it. Investment in what? If I'm going to hold it for only a few days to a few weeks, I call it a what? Investment in trading securities. Got the idea? What if I'm going to hold it for more than a few weeks up to a year? Investment in what, guys? Available for sale short term.
And then how will we know? Like, you just tell us in the problem.
I'm going to have to tell you how long you're going to hold it. You got it. So I'll say they plan to hold it a couple days, right? Temporary, real temporary. Or they plan to hold it for 6 months. Or they plan to hold it for 3 years. Got the idea? I'll tell you. Okay? So we'll look for that in the problem. You got it made. Okay? Investment and available for sale. Short term. Short term. And credit cash. Okay? So that's pretty simple, huh? Key thing is, what? How much do I own? Then secondarily, how long am I going to hold it? What would you call it if you're going to hold it for more than a year? Investment in available for sale, long term. And credit cash, 16,000. By the way, where are you going to put these on the balance sheet? Where do you think trading securities and short-term available for sale are going to go? Current assets? Where do you think investment in available for sale long-term is going to go? Non-current assets, right? This is not hard, guys. Right? Okay. So what would I call it, though, if I'm going to use this equity method? I have significant influence. So 25% I bought. Investment in what, everybody? In affiliate, right? It's an affiliated company. Affiliate XYZ company for the $2 million. Okay? What am I going to call it if I invest in a subsidiary? You know, where I have control. How about investment in subsidiary? Okay? Rocket science. Okay? and you put the company name on it, right? Investment subsidiary, typically with those are huge investments, right? That's it. Okay, we're in. Okay. So then what are the things I need to worry about as time goes by? What's the company going to be doing? They're going to have a change in market value. Got it. Okay, so first we did the investment, right? That's the investment. Let's do change in market value. Okay, what's that going to look like? So we have either an increase or decrease in market value. I did an increase for the other class. I'll do a decrease with you guys. Right? That's fine. Let's say the market value goes down. What would I bought them for $8? Let's say at the end of the year they're only worth 7. Okay, market value at the end of the year is $7. Let's say that. Okay, so we're going to account for that in all 3 cases. Okay, market value at the end of the year is $7. What's the other thing that might happen? It could go up. Okay, it could go up or down. If it goes up, I have a unrealized gain. If it goes down, I have a unrealized loss. If it goes up, I'm going to have to increase the investment. Don't you suppose? If it goes down, I have to decrease the investment. That's going to work great, huh? Because if I debit the investment increasing it, I'll credit a gain. If I credit the investment reducing it, I'll debit a loss. Yeah, you got it. Okay, you guys know what you're doing, don't you? This is just like selling the past. We didn't sell it, right? Okay, change in market value. What else happens though? It's not just a change in market value. What does the company do? It runs all year, and they make what? What'd you say? They pay a dividend. Okay, so let's say they do a dividend. Okay, so the dividend, let's see, how big was this company? It was $8 million company. Let's say that their dividend is $300,000 for the year. Okay, that's in total. Okay, they pay a dividend, huh? If I own stock, are they going to pay me a dividend? Sure, I'm going to get the cash on it, right? In every case. And then what else happens? Why are they able to pay a dividend? Because they make net income. That's it.
What does it say there, right next to 300,000?
Total.
Oh.
Net income, let's say their net income is $1 million, okay? They made $1 million, and that's their total income, okay? Got it? Now, this is going to be different. If I have no control, what am I doing? I'm taking what the market gives me. I'm a passive investor. Make sense? If I'm a passive investor and I'm taking what the market gives me, what am I going to do when the market value changes? I'm going to need to record the change in market value because I'm taking what the market gives me. Okay? So here, yeah, I'm going to show the increase or decrease in market value, right? Okay. In my trading security, available to sell short term, available to sell long term. What about the dividend? What is the dividend to me? It's income, right? The 2 sources of income I have if I'm a passive investor is what? Change in market value, hopefully increase, and dividends, right? What about when they report net income? Did I make the net income happen? No. So guess what? No entry if I have no control. Got it? In that category, no entry. Okay, so then let's move over to the investment in the affiliate. What's the deal there? Here I have significant influence. The change in market value, if it goes up, I'm happy, but am I selling the stock? No. By the way, if you own more than 20% of the stock of a company, you think you're going to sell it in a few days? And I doubt it. If you buy a whole bunch of stock in a company, then you try to sell it real fast, what's going to happen? Bottom's going to fall out on the market price, you're going to lose a fortune. Nobody would do that. What if I own more than 50% of the company? Even worse, right? You're not going to do that. So which stocks are you buying and selling constantly? Trading securities and available for sale, right? Absolutely. Okay, that's where the trading's going, in smaller quantities, right? Okay. So what about the change in market value then? This is going to be easy. No entry. Oh, why is there no entry if I have significant influence? Because I'm not holding it for appreciation, really. But what's the deal? If I have net income, who earned the net income?
what percent of the company do we own? 25%, was it?
Yeah.
If I own 25% of the company, what share of the income do I get? 25%. What share did I earn? 25%. I don't know. But when I pay a dividend, let's see, I earned 25% of the income. When I paid the dividend, what did I do? Paid myself 25% of the income in a dividend. I have less investment now, and that's how we're going to account for it. So it's a whole different thing. It's not dividend income to me anymore. It's a reduction of my investment. Okay? What's going to happen on a subsidiary? No entry there too. Now the nice thing with a subsidiary, and we'll do this next time, the nice thing with a subsidiary is you don't have to record the net income or the change in market value, because you're going to eliminate the subsidiary anyway. It doesn't really exist. What you're going to do is you're going to add together the assets of the company and the subsidiaries, if they own a bunch of them, right? You're going to add together all their assets, all their liabilities, and you're going to eliminate the equity of the subsidiary and eliminate the investment in the subsidiary when you put the statements together. We'll do that next time. Okay, so no entry there, no entry there. Don't you love these when you can just write down no entry for me? It's nice, huh? Okay, so let's give this a shot. Let's try the change in market value. This time what we did was we decreased it, didn't we? Went down by $1 a share. Everybody agree? How much money did you lose? You have 2,000 shares and it went down by $1 a share. $2,000. That would be a what? Loss, but it's unrealized. Why is it unrealized? Because we didn't sell the stock, right? Okay, so it'd be on the first one, if you recorded this as an investment in trading securities, it's going to be easy. I'm going to debit unrealized loss on, guess what? Trading securities. It'd be 2,000. And what do you want to do to the market, or to record this at the market value? You put it in at 16,000 because you bought them for $8 a share, and there's 2,000 of them. What are they worth now? $7 a share on 2,000 is only 14. How much do you need to reduce investment in trading securities by? Yeah, that's it, 2,000. So again, don't fall back on remembering, huh? Figure it out. It's easy. Okay? We're exactly where we want to be, huh? Now, what financial statement does that loss go on? And it's trading securities. So we think it's going to be permanent because we're going to sell in a few days. So we go ahead and run it into the income statement. That is a loss on our income statement that will be closed to retained earnings. It's the only one that goes there. Okay, you got it? Well, what if this is an investment in available to sell short term or an investment in available to sell long term? What will I do? I guess I'd have to credit that account, wouldn't I? Whichever one it is, you would credit investment in available for sale. If it's short term, credit short term. If it's long term, credit the long term account. Make sense? By how much? Still went down by 2,000, right? You just have them categorized differently. Okay, so you go to whichever one of those accounts you originally recorded it to, and what's the debit going to go to? It's still going to be called an unrealized loss, you guys, but a critical distinction on this one. Unrealized loss on available for sale, either short-term or long-term, right, depending on what kind it is. And where does that account go? That's the other comprehensive income. It's an equity account, okay? So that's an other comprehensive income account. It goes to equity directly. So like I said, if you have really big gains and losses on available for sale securities, where is it at? In other comprehensive income, not on the income statement. You have to go to the equity statement to find it. And it can be big, right? It can be really big. So you always want to look at other comprehensive income. Okay? All right. Still fine. What would a dividend do? How much dividend am I going to get? I own 0.2% of this company. They're paying $300,000 in dividends. What do I get? 0.002 times 300,000 is what? $600 bucks? What's another way you could do it? You could take 300,000 divided by 1,000,000 shares, and what's that? 30 cents a share? What's 30 cents a share times my 2,000 shares? $600 bucks. Can you guys do this? Of course, right? So what are they going to give me when they pay me the dividend? I think you give me cash. What did I say, $600? And credit what for 600? I'm taking what the market gives me. When the market value changes, I have unrealized gain or loss, right? What am I going to have if they give me a dividend? Dividend what, everybody? Dividend income or dividend revenue. Okay? It's just like interest revenue, interest income, same difference. Everybody good? So pretty simple? And that's it. No entry on the net income. Why? I did not make it happen. I do not run the company. Okay? All right, let's switch over then. What if I have this 25% interest, anywhere between 20 and 50? So it's an affiliate. I'm using the equity method, right? I have significant influence. What do I want to do? The change in market value, nothing. What about the income? Who earned the income? I did. They earned $1 million. I own 30% of the company. What did I earn? I own 25% of the company. What did I earn? 25% of $1 million. I earned 250. I think my investment went up by the 250 that I earned. And I think I have income that I should put on my income statement of exactly the same amount. Okay? So I'm going to debit investment in affiliate. Investment in affiliate. The same account that I originally recorded it to, okay? It goes up by 250,000, doesn't it? My 25% of the net income. And I'm going to credit income from affiliate, which is an income statement account, for 250,000. Now here's the deal. I think my investment went up by my share of the income, and I think my retained earnings should go up by my share of the income. That's it. Going to track directly with it, okay? No big deal. What am I going to do when I get the change in market value? Nothing. I'm thrilled if it goes up. I'm sad if it goes down. Why do I like it if it goes up? If we issue more stock, remember I help them run the company. If we issue more stock, we get more money for it. I like it to go up. What if it goes down? We get less. So of course I like it to be worth more. If I were to sell it, of course I get more for it too, right? But I'm not holding this company for change in market value. I'm holding it long term, right? Got the idea? Long term, and I'm helping run it. What about the dividend? What's that going to be? How much of the dividend do I get? It's still going to be debit cash, but how much of the dividend am I going to get? I guess if I own 25% of the company, I'd get 25% of the dividend. I'm going to get 30 cents a share on, how many shares do I have? What did I have? 250,000 was it?
Yeah.
Right. 30 cents a share on it. How much is that? 75,000. Or you could say there's 300,000 total dividends. I own a quarter of the company. What am I going to get? 75,000. So it's $75,000, isn't it? Dividend I have. But here's the deal. I paid myself a dividend. I recognize income. Oh, by the way, you could call that income from affiliate, or I think the author calls it equity interest in affiliate income or something weird like that. Okay, there's all kinds of different terms that are used. Okay, so I like income from affiliate because it's simple. Huh? Okay, but it is your equity share, right? Okay, anyway, I already recognized the income there, didn't I? So should I recognize the dividend as income too? Of course not. You'd be double counting. What happened? I earned $250,000 and decided to pay myself 75 of it. That's what happened, right? Okay? So I'm going to credit investment in affiliate. And we are there, you guys. All right? So as the retained earnings of the affiliate goes down for the dividend, right? Because they would debit retained earnings, wouldn't they? And credit dividends payable, and then later credit cash, right, guys? For the whole 300. As the equity goes down, the retained earnings goes down at the affiliate, I'm reducing my investment in the affiliate. As the retained earnings goes up, right, when they're recording income, right, that I increase my investment by my proportionate share. Okay, that's all that's happening. And we'll mess with that in a review session too. So that's it, huh? How about if it's gonna be consolidation? Well, in this case, we're gonna get, what percent do we own, 80%? We're gonna get 240,000. Right, everybody agree? It was 800,000 shares at 30 cents a share. So, we could either go to investment in subsidiary with this, which is fine, because we're going to close the investment in subsidiary anyway, right, when we do consolidation. Or if you want, you go to dividend revenue. But you know what? We're going to eliminate that too. So really, it doesn't make any difference. Here's the deal. When I give you problems, I won't give you any dividends if it's a subsidiary, just to keep it simple. Okay? So next time we'll do the elimination. Okay, guys? Yes, ma'am.
Why is there no increase for net income for subsidiary?
For the subsidiary? Because I'd have to eliminate it anyway. That's a great question. I'm going to eliminate it anyway, so why record it? And the answer is, you could record that if you want. You could use the equity method on the subsidiary and then eliminate everything. So if you're doing separate financial statements for the company and each of the subsidiaries, you'd probably do that. And then eliminate it all anyway. It just makes a huge elimination. If you become an accounting major in accounting 414, we'll do that. The best. That's all I can do.
My car and drive now, and it's only, Young was hiring for attorneys.
Yeah.
I was like, oh man, I already have the own proposition, but,
That's just fine.
I was like, I'll email them anyways. Emailed them, had an interview Friday, 45 minutes later, they told me I had the job.
Oh, Young? Are you going there instead? They
emailed
have some really nice things. You haven't told the other one yet.
I already told them, I'm not gonna do it.
Oh, yeah, you never said yes to them.
I kinda did, but they never emailed me back, so.
Oh, all right. Okay, well, they're slow.
Yeah.
They'll speed up next time. Yeah. Young's a great one. They will give you more money as time goes on. They'll give you more responsibility. They'll try to convince you never to leave and do public accounting, and you'll leave anyway.
Yeah.
To get the experience, and then they'll hire you back if you want later. It's a great.
Did you end that?
And they make great health food too. I'm kidding.
I was gonna say when.
Did you hand out that quiz from last week?
Oh, from last
Beginning
year.
class?
Yeah. Did you get yours today?
No, I was like,
What's your last name?
first.
Did you sign up for 211 in the fall?
Yeah, I'm doing one of Julie's.
Cool. Good deal. You're doing the same thing?
No, I just needed the quiz back.
What's your last name?
Taylor.
You're not majoring in accounting?
Actually, fine. Oh, it's a great double major.
Yeah,
You want to work yourself after that? Actuarial science and accounting.
And
Unbelievable opportunity. Oh, what a triple.
Yeah, yeah, you're very. But
yeah, I'm doing the actuarial science at Econ.
yeah, that's a good mix too. It's a good mix.
It's just 3 extra classes for the double major.
Yeah. This one would be a lot more.